Before I turn it over to Steve, this is just a reminder that this session is for research purposes only and not related to any specific fund. Steve, with that, you can get started.
Hey, thanks, Phil, and thanks everybody for joining us. I'm going to present some results for the Cliffwater Direct Lending Index. Again, not the fund. I'm going to be talking about the index for the next few slides. We just reported a few days ago results for Q3 2025. I might mention the index is really a very good representation of U.S. direct lending. The total value of assets now exceeds $500 billion, representing about 40% of the entire market. The 60% that's not represented is probably a mirror image of our index. So the data we provide, I think, is a very good reflection of the overall market. And speaking of the overall private debt market, it's been really quiet on the ground, despite all the headlines. The actual data suggests everything is going as expected in the direct lending market. Maybe can't say the same for the broadly syndicated market, but our focus is on private debt, primarily direct lending. If you look at the table, we break down returns over several time periods. The third quarter, Q3, first column, CDLI total return 2.41%. That's basically interest income of 2.5%. Very little in terms of realized losses and unrealized losses. Over the trailing year, the second column, realized losses, which is our focus, 61 basis points, well below the long-term average of 1%. So, yes, interest income is slowly declining as Fed funds gets cut, but basically very little is being lost in terms of realized losses for the index. If you look at the graph at the bottom, basically these are quarterly returns for our index, and again we think this is very representative of the marketplace. Basically, you can expect total return ranging between 2% and 4% over time. Intermittently, caused primarily by recession, there are negative returns. And if you do see negative returns, at most, they're single digit. So we consider this a very good return pattern for a diversified portfolio. And that's why for our clients, we recommend a significant allocation to private debt. Next slide. Yeah, so focus a little bit here on the components of the index total return. I talked about interest income, pretty steady, ranges between 10 and 12% over time. Our last print for Q3 was 10.67%. The idea is to capture that interest income by not experiencing realized losses in principal. That red line is realized losses in principal. And the difference between the bars and the line represent the income that's captured after losses, which continues to be very significant. If you look post-COVID, the realized loss rate has been, it's averaged well below 1%. And I don't know what all the fuss is about in the broadly syndicated market, but in the private debt market, U.S. direct lending, so far it's very consistent and attractive. Next slide. Yeah, and I want to talk about unrealized losses. We've had very little unrealized losses, but I'd like to talk about this because I think it's important. Basically, unrealized losses make themselves apparent, particularly negative unrealized losses, before realized losses are experienced. Basically, unrealized losses reflect markdowns in portfolio values, NAV, and they're part of independent appraisers. And when markdowns happen, it's generally in anticipation of future realized losses, future defaults. And we've shown that's been the experience over the last 21 years of the index. So for example, financial crisis, unrealized losses, markdowns 16%. Subsequently, realized losses were down 9%. During the oil crisis, down 4.75%. Subsequently, minus 1.86%, and so forth. Basically, unrealized losses are a predictor of future realized losses, but they overshoot. Consistently, the unrealized losses are 2 to 3 times what actual realized losses are. So I bring this up only because basically over the last couple of years and currently, there are very little in terms of unrealized losses. So the market is not anticipating anything going astray. It's not anticipating higher future defaults in subsequent quarters. A lot of press on defaults going up and so forth. That's kind of reversed lately, but basically we look at unrealized losses as a predictor, and it has been a good predictor in terms of realized losses. It's just that valuations tend to overshoot over time. Next slide. Yeah, so all in, I wanted to, at this time, in December of every year, I generally put together forecasts for the Cliffwater Direct Lending Index over the subsequent year. It's a good barometer for actual the return on actual private debt funds. But let me focus first on the far right-hand column, 2025 forecast. So we predicted for this year 9.30% for CDLI. We haven't closed out 2025. It'll probably be a couple months before the final numbers are in. But if you look at the 4 quarters ending September 2025, in that middle column, basically we're at 9.80%. You know, we're going to drop off the fourth quarter of 24, add the fourth quarter of 25. The SOFR will have gone down, but basically, I think our prediction for 25 will be right on for the calendar year. Importantly, we were forecasting in terms of losses 75 basis points. So far, we're showing 61 basis points. So all we're very pleased about our forecast. We're we're not on the prediction basis. The point here on private debt is we may be wrong on our prediction, but the variance is going to be very small. I mean, the predictability of direct lending is really good. So our 2026 forecast, let me start at the top. Our SOFR rate, if you look at the forward curve, SOFR forward curve, the reference rates, we believe is going to be at 3.50%. That's the market forecast. We have the same credit spread, 6%. Interest income will be 9.5%. Realized losses, we're predicting for the index of 65 basis points. That gives us 8.85%. So we may be a little bit higher or a little bit lower, but that is our forecast. And it's in our mind attractive against most other asset classes, yield or growth-oriented asset classes. So again, we find direct lending an attractive place to be. Next slide. Okay, let me finish with this. This is a little complicated, so if I could have a little more of your attention, I'd appreciate that. So basically, what are we talking about here? Valuations are high, spreads are low. People are asking, hey, is it time to de-risk? Or they're questioning equities, they're questioning private debt, they're questioning liquid debt, they're questioning Bitcoin, et cetera, et cetera. Our position is buy and hold is the best strategy. It'll work out. Trying to time the market really can trip you up. So how are we trying to demonstrate that? So in the first column, I've taken all these yield-oriented indices, and I show the 20-year return for these indices. The direct lending index at 9.55 down to treasury bills at 1.60%. In the right column, the right two columns, let's start with the first right column. We show a strategy where, let's get out of the CDLI, let's get out of private debt and go into some other asset class if the spread to that asset class is extremely narrow. And we define narrow as a 10th percentile spread. So again, reflecting a very narrow spread with the other asset class. So if you look at the Cliffwater Direct Lending Index with itself, it's 9.55%. So that's not changing. But what if you did a strategy where you invested in liquid credit, particularly the leveraged loans, when the spread got very narrow, and you did follow that strategy over the last 20 plus years? Well, you would have done a little bit better, 9.58%, but not material, three basis points. If you try to time using the same type of protocols with corporate high yield, may have done a little better, 9.96%, so it maybe add 30 to 40 basis points. If you did the Bloomberg Muni Index, your return would have gone down 8.90%. Taxable equivalent index, 8.69%. If you did with T-bills, 8.46%. So, but bottom line, trying to get in and out of private debt using the direct lending index as a surrogate, at best it was probably break even. At worst, particularly if you went to cash or muni bonds, you would have been hurt following that strategy. I might also mention that these results are probably, the timing results are probably optimistic for two reasons. One, it's in sample. So for you statisticians, this is not an out of sample type survey. It's in sample, so it's somewhat biased upwards. Secondly, we've shown you can match the Cliffwater Direct Lending Index, but Morningstar and corporate high yield with their fees. Generally, if you invest in BKLN or junk, you're going to be 1% below. So this, in our mind, demonstrates, hey, buy and hold, invest in private debt. Don't try to time that market. But you may say, hey, well, let's be a little more aggressive. And said 10%, that's awful restrictive. Let's look at the aqua columns at the right and do 25th percentile. And these results end up being even worse. So, the more market timing you do, the worse your result. I also show the positions, the end of period positions, where you would be invested at September 30 following these protocols. So anyway, things on the ground, summarize my section. Things on the ground look fine. Okay. The only bad news, the reference rates are coming down. Can't do anything about that. But buy and hold strategy looks very good, continues to look very good. And just be very careful when you're tempted to start getting involved in timing these different yield-oriented asset classes.